Hello everyone, Jeff here from RCN Capital with the magic man, Mr. Chris Doran, head of sales. Welcome to our podcast.
Thank you, Jeff, and thank you, Rick.
So, Rick, it is great to be back with you again. I feel like we haven't seen each other in quite some time. We're trying to step up our game this year, bringing in Chris, who is in the trenches with the sales staff, really just trying to become more of a conversation on what's happening in the marketplace. You know, we just put out the investor sentiment survey. I think it is our third iteration. The data keeps getting better and better. Let's start high-level view, your takeaways, 30,000 foot, on what came out of this go-around with the investor sentiment survey.
Thanks for having me as usual, Jeff, and good to see you, Chris. And we haven't really spent any time together since last year, which sounds a lot longer than it actually is. The winter survey was a little bit of a mixed bag. I think investors have some trepidation coming into the new year, but by and large, we're probably no less optimistic than they've been in the previous two surveys about where they see things going. I think the big sort of aha moments for me as I was going through the data with this particular survey were how differently fix and flip investors view the market than rental property investors do. And the other is the impact that a new variable that we put into the survey, the issues that surround insurance these days is already playing in the market for investors.
So that's a great question, right, Chris? Like, we're closing hundreds of loans every week. I keep hearing insurance. Rick, it came up in the survey. What did folks say?
Well, funny you should ask. We asked the survey respondents if rising insurance costs or problems with getting insurance were becoming a factor in their decisions to even invest in real estate. Almost 69% of them said that it was becoming a factor. And when we asked them if the same issues were creating problems in their ability to buy and sell properties, about 62% said they were already becoming problems. So, it probably shouldn't have been a huge surprise. Although what it says to me is that where we might have been thinking that rising insurance premiums and the inability to get insurance were problems that maybe were isolated to a few states, it might be more of a national issue than we've really thought it was in the past. We knew about problems in Florida with flooding. We knew about problems in California with wildfires. To a lesser extent, we probably thought about issues in Texas with the severity of hail events they have in that state. But when you're talking about more than 2/3 of your respondents saying, hey, this is a concern I have, and it's because of price or the unavailability of insurance, that does suggest it's becoming more and more serious of an issue.
So, Chris, and I'm going to toss it to you because I'm hearing from the sales staff all the time, wow, this deal doesn't pencil out the way it used to because of insurance. My guess is you're hearing it all the time as well.
Yeah, it's a consistent theme of customers that, as you're trying to, particularly for the DSCR loan, right, that cash flow calculation is such an important piece of the puzzle to qualify at max terms. And when you were expecting insurance maybe to cost you $1,200-$1,500, and then you get hit with something that says $2,500, $3,000, like, suddenly you're starting to feel a little anxious about what your expectations were for that particular property and the investment plans that you had made maybe 6 to 12 months earlier when you first bought that property and started rehabbing it. Now you're ready for that takeout loan and you're in a position where the cash flow isn't penciling out the way you used to think it would. And so that's where you have to, as a lender, come up with alternative options to help people improve the cash flow, maybe make a referral to, try to shop around for the insurance and see what you can do to get a better price point there because, Rick, you mentioned the states, Texas, Florida, California. Well, those are also some of the three, obviously, most populous states, but the three busiest states for investor activity too, right? So it really has a multiplying impact on our book of business when we see states like Florida getting hammered with really high insurance costs. and no real end in sight to that either. And we've seen the insurance market and carriers start to leave some of those markets too, right? And that's also causing a real strain on the premiums that you're seeing. But if they're pulling out of certain markets and parts of the country, there's going to be a ripple effect in the other states too. We also have the contributions of just the natural, inflation talk that's been going on for over a year now, and you're seeing rising prices kind of go across the board. So it does affect all markets, but as Rick said, some of those markets are really getting hammered. It makes it difficult for investors there. So, you probably didn't do that homework maybe as an investor earlier on in your career where you were pretty certain about what the cost of insurance is. Now, before you're buying that property, you want to find out what the cost of that insurance is going to be so you can make sure that deal's still going to pencil out at the end of the day.
And fix and flip investors get it twice. You're right. Your observation's spot on about rental property investors who need to figure out cash flow in the long run and probably have to build in estimated increases in insurance premiums over the years as they do that. But if you're a fix and flip investor, you first have to factor in whatever it's going to cost you to buy insurance when you get the property in the first place. And I know I've talked to some flippers who tell me that in their markets, the insurers will only sell them a full year premium. So it's not like they're only looking at it for a few months while they're fixing the property. And then they have to make sure that the property is affordable to the prospective buyer, who's also going to have to factor in insurance costs in terms of their ability to afford the property or even to qualify for a loan. And to your other point, Chris, we've also seen property taxes go up across the country. That's something we really haven't talked to investors about in our survey. But when you have home prices go up as dramatically as they did over the past few years, it tends to bring property tax costs up as well. And in some markets like Tennessee, for example, they only update those taxes once every 4 years. So can you imagine the sticker shock somebody's getting after seeing property values soar in Nashville and getting that kind of unexpectedly high tax bill after a 4-year delay.
Well, you also see that tax factor come into play because so many of our investors too, they're buying the property, they're investing rehab into it, they're improving the value, they're pulling permits and stuff too. Towns take notice of that and suddenly your assessment and value goes up and now your tax bill is going to be a little bit higher on that front too. So that's something else we see all the time too. Or somebody who's buying a new construction property, right? You go on the tax record and you see, oh, this is really cheap taxes. Yeah, that's because it started as vacant land. They haven't updated the tax records yet. Once you put that $400,000 or $500,000 house on it, your taxes are going up, and you have to factor that in as well. So investors have to be a little bit savvier when it comes to anticipating those insurance costs, but also the tax costs that are going to increase over the years as different towns and municipalities are trying to pay their own bills.
Rick, are the number of insurance companies across the United States that investors are seeking out, are those staying steady? Are they decreasing? I know in certain states, certainly on the owner-occupied side, certain insurance companies have pulled out altogether. What is the marketplace like for investors with insurance today?
It's probably pretty similar. Obviously, there are some insurance companies that specialize in these types of policies. But if you're holding a property long term, you very often are dealing with very similar companies to what consumers are dealing with. And again, generally, we're looking at the same sort of market conditions. I think there's probably not significantly fewer, but somewhat fewer numbers of insurance carriers who are available for investors. And it's a tighter market. It's not like the old days where you could go get competitive bids from insurance companies. Now you're just about begging them to let you get insurance from them. So it's a very different market for investors these days.
So there was a ton of data in the investor sentiment survey this go around. Let's transition into the likelihood of a recession. Like, folks love to think about a recession and what it's going to do, especially for rental property owners. Oftentimes, many folks that are renting, they may not have the security of a job that other folks have, and a recession could really hurt them. And as an investor, we certainly care about how that's going to affect the likelihood of folks renting from our customers as lenders. So What kind of folks, what kind of data are we hearing from folks, and what are your thoughts on the likelihood of a recession?
Yeah, it's wish I had a crystal ball that I could look into and tell you that specifically. We are seeing um, a continuing situation where more investors believe we're likely to see a recession than not. I think the rental property investors are a little bit more negative than fix and flip investors because they're already starting to see some economic hardships. I can give you two kind of specific examples. One is that during the pandemic recession, we saw 22 million jobs evaporate overnight. Now most of those have been recovered, but the majority of those jobs probably were renters. And so there's some continuing fallout in the rental markets of people that didn't pay rent for a couple of years, and there were eviction moratoria that were in place, and so forth and so on. And so there's already some hardships for those rental property owners. What we've seen in the last year is that asking rents on a year-over-year basis have gone from ridiculously high numbers, like 15% increase in asking rents on a year-over-year basis, to flattening out completely, and in some cases, actually going into negative territory. Now, fortunately for most of the people who are likely to be RCN borrowers, the single-family rental market fared a little bit better. At the end of the year of 2023, nationally, we were still seeing rental increases of about 2.5% to 3%. That's not a big number, but it's better than going negative, and it's certainly better than what we were seeing in the apartment community. So I think it's a little tougher for some of those rental property investors to kind of maintain that optimism that we often see in the investor community. And I think since they're seeing some of their tenants struggle a little bit, and we're seeing some signs of consumer weakness that I'd be happy to talk about a little bit more, that they are more inclined than not to think we're likely to see a recession this year.
Chris, is that something that investors are talking about to our loan officers?
Yeah, at different times it's going to come up, and I think one of the ways that investors are really looking at this too, as Rick kind of alluded to, right? If you're in a landlord situation, if you're, depending on market, it is very market dependent, right? Different parts of the country have been impacted differently, but if you were used to getting or planning as part of your strategy to increase rents over time and really develop a better cash flowing property, well, that might not be as possible as you thought it was a year ago, right? And again, I think there's a floor to that market, though, because home inventory is still light. So there's not a whole lot of places for people to go to. But certainly if we get into a point where people are getting laid off again, and you suddenly have tenants who aren't going to start paying, that will disrupt that market quite a bit, right? And kind of go back to the recession question there. Last year, everybody seemed about this time of year, 100%, we're going to be in a recession at some point in 2023. And the more I've, heard Rick talk about this stuff, and I look at the data and I read the different articles and things like that, I wonder how much of the idea of how we traditionally define and accept what a recession is really the standard we should be using in the future too. Because we do have some odd things in our data telling us where people say, oh, we're going to be heading towards a recession, but you get these awesome job numbers. We've seen some extreme GDP growth in some of these quarters too. And it seems a little counterintuitive to some folks that we see this big GDP growth and the jobs numbers that we're getting, and yet at the same time, there's a lot of concern about that recession that's still coming. And I think one of the things you might be looking at there, Rick, is the credit card debt that Americans are holding right now, and maybe talk about some of those other factors that maybe we don't traditionally consider when we're just talking GDP and high-level things when we talk recession. But there's a lot of underlying factors there that maybe paint a different story than what people traditionally think about.
Yeah, great, great points, Chris. There's some recent data that just came out. In fact, this morning, as we're talking, retail sales fell off a cliff in January. Now, I'm going to say fall off a cliff because they were much worse than economists had forecast. It was almost a full point decline, which doesn't sound like a lot, but economists have been projecting about a 0.1% decline. So the numbers came in about 10 times worse. You talked about credit card debt. In the third quarter of last year, we exceeded $1 trillion in credit card debt from consumers for the first time in history. Early projections suggest that the fourth quarter numbers were even higher. That came at a time when interest rates on credit cards were at all-time highs because of how high the Fed had raised the Fed funds rate. So the average credit card interest rate on a credit card issued in that quarter was 25%, which used to get people arrested for usury, but now apparently is the new normal. And so they're financing all of what they're doing at very, very high rates. And not surprisingly, we're seeing delinquency rates in just about every category of consumer credit go up. We've seen auto loan delinquencies go up. We've seen credit card delinquencies go way up. We're seeing consumer loan delinquencies go up. And for the first time in a while, we've had 2 consecutive quarters where mortgage delinquencies have gone up. Now, they're still not back to normal levels in the case of mortgage delinquencies, but they're getting closer and closer. And the only category that isn't showing an increase in delinquencies right now is student loans. And I believe the only reason for that is we've only had a couple months where student loan payments were required. So that data is probably lagging. So, there are some signs of consumer weakness in the economy. At the risk of sounding very cynical, it would be highly unlikely, highly unusual to see a recession in a presidential election year. I think that happened to Jimmy Carter, and we know he didn't quite make it to his second term, but it doesn't happen often. And so will the economy slow down this year? Probably. Will it slow down that unemployment jumps up enough that it has a huge impact on the housing market? Probably not. And that's probably true whether we have a recession or don't.
Before we wrap up this topic of recession, you must look at the amount of money that's been pumped into the system since the stimulus and how much of that money is still having an effect on the economy and whether or not that will expedite a recession, prevent a recession, or maybe that soft landing that everyone wants.
So I think the best way to categorize it, Jeff, is we went through 2 stimulus packages, stimulus 1 and stimulus 2. There are a lot of economists that thought stimulus 2 was over the top. We didn't really probably need it at that point. One economist that I know, I think categorizes it extremely well. He said the government tried to fill a $3 trillion hole with $15 trillion. And we doubled the monetary supply, and the Federal Reserve bought billions and billions of dollars of mortgage-backed securities, which is one of the reasons that mortgage rates were driven as low as they were. And that lowered a lot of people's monthly home payments, which made them flush with cash. Student loan payments weren't required for 2 years, which saved those households on average $200 to $300 a month in cash. And again, we had all that money floating around from the $15 trillion in stimulus. I think that's propped up the economy for a few years. Those multiple factors have propped up the economy. But we're starting to see some chinks in the armor. We've seen the personal savings rate go down to an all-time low as people burn through the cash they put away during the stimulus periods. We've seen credit card debt increase, which leads me to believe there's at least a certain number of households out there who are using credit cards to make ends meet, which is really not a good long-term solution. So I think we have seen the economy benefit from all that stimulus. We've seen the economy suffer from all that stimulus because you can't inject $15 trillion into our economy and double the monetary supply and not have inflation. So for all the talk about supply chain disruptions and Russia invading Ukraine, the real root cause of the inflation that we're fighting right now is all that money that was pumped into the system. So it's been a little bit of a double-edged sword. I think there's probably not as much of that cash in the system now as there had been in the previous few years. And so whatever positive impact it was having on the economy is likely to be dwindling pretty significantly. The other thing I'd point out, Jeff, is a lot of people are saying, okay, we've avoided a recession. We're looking at a soft landing now. And isn't the Fed masterful in how it was able to achieve that balancing act? People forget that when the Fed raises the Fed funds rate, it doesn't have an immediate impact on the economy. There's a lagging effect on the economy. And it's not unusual for that effect to lag by 6 to 18 months. So while it may look like a soft landing right now, I'd caution people to say we're not necessarily out of the woods just yet. And the nature of the increase in the Fed funds rate, how quickly it went up, how high it went up, it'd be really, really unusual, almost a miracle, if it didn't have some sort of negative impact on the economy before it's all said and done.
So as we stay on macro topics, I'd love to get to the topic which is the water cooler topic at every mortgage company and every investor shop in America, which is the interest rates. Where are we going? When are they coming down? Certainly the Fed speak has been, we're done raising and we're going to be looking at lowering rates. Certainly the data has been variable over the past 6 weeks. Where are we going and what do you see, Rick?
Yeah, this is probably the $1 trillion question for the housing market, right? And for the private lending industry. The most likely scenario is that we see finance rates slowly and gradually come down over the course of the year. I do not believe they go down in a straight line. And we've seen this in the first 2 months of 2024. We saw mortgage rates, for example, come down, and they came down for a week or two, then they went back up. And I think that's going to be the model for the rest of the year, a gradual slope down, but in kind of a sawtooth manner, where they go up a little bit, they go down a little bit more. They go up a little bit, they go down a little bit more. I don't personally expect to see a meaningful drop in mortgage rates until the Fed actually does execute its first cut to the Fed funds rate. I think the market will probably wait until that happens before we start to see a rate adjustment of any meaningful amount. And because of that, and because I don't think it's at all likely that the Fed does that first cut in the first half of the year, if they do, maybe at the May meeting, but my best guess right now is it doesn't happen until the second half of the year. That kind of slows down the degree to which we can see mortgage rates come down. And so my best case scenario right now is we get to the end of the year and we're just barely below 6% mortgage rates. But even that will feel a lot better. And what that scenario suggests, Jeff, is that because we're in such a rate sensitive market, we'll probably see buyers enter the market much more quickly than home sellers, which means the inventory levels won't come up very quickly. And we'll have more people competing for limited numbers of properties for sale, which means home prices are more likely to go up this year than go down.
So Chris, we continue to see robust activity, especially on the DSCR side, with where rates are today. I think investors want to know if rates come down as Rick has predicted, and I can't ever recall Rick being wrong.
Talk to my wife.
Cue the laughter, Rick. Cue the laughter. Listen, if we get down to 6, under 6, like, wow. I would think activity on the origination side, investors are going to be out there buying. What do you think? Absolutely.
If you look at the the investors who are interested in doing, a rental model, again, for those folks in the marketplace, the lower interest rates are going to drive better cash flow for them, right? So now that rental property that maybe didn't work out so great, well, maybe now it's got some nice cash flow and I can put some money in the bank with that, right? I think it's going to have a big impact on the fix and flip investor, though. As you look at a fix and flip scenario, what we saw a lot during 2023 and in the early parts of 24 was investors who purchased that property and rehabbed it and thought they were going to be selling at a certain price point. That price point wasn't necessarily there for them, depending on what segment of the market they were in, right? If you were, rehabbing homes that were kind of in that starter home kind of market, much more stable and reliable inventory turnover in that market, right? You generally didn't have an issue hitting your price point. You didn't have to have it listed for 2-3 months at a time. But if you were in those like higher level categories of the price point of the market, you saw your house sit for a minute. You weren't getting those multiple offers just on one showing anymore. It might be sitting 30, 60 days. You might see some price reductions in that, and that really changes the investor's, profitability and outlook on that. But just the fact that they don't have that certainty that they know the property's going to sell quickly and they can recycle that and go into their next project, right? That puts a big delay on their own supply chain of production and how that's going to work, and what an impact that has on their contractors, on all the people who work in their office and their marketing teams, right? The bigger investor shops are going to, have to adapt to that, right? And with inventory being light still, you're going to have to really hunt and search and do your research and diligence to find those good properties that you can invest in as a flipper. So inventory is still going to be a difficulty there, but the rising price point is really going to help drive those quicker sales on the back end for them too, assuming you're at the right price point in your market, right? And you really got to know your market as an investor, because if you're not, rehabbing to the right levels in your market, you're going to struggle. And if you're not putting things to, the right expected consumer base that's potentially going to buy that property, you're going to struggle. And so what we've seen over the last year is really an environment that's caused investors to sharpen their pencils and get better at the diligence of their own projects, right? 21, 22, you could buy properties and the market would bail you out. You were going to make money on that deal. Didn't happen in 23. A lot of investors had to go back to the drawing board and reassess their strategies and how they go about things. And if you're going back to the market this year, I would say, learn what you took from last year, keep those pencils sharp, and continue to improve your process over time. There is no set way of doing this business. You constantly have to adapt to the market, and the better investors who do that will be successful.
That's great advice. And Rick, before you go there, I would love for you to opine on the amount of housing that is going to be available. As Chris stated, it's a challenge out there.
Yeah, and then let's circle back to some of Chris's comments on the fix and flip market, because I think he said some really important things there. Right now, as we speak, there are about 500,000 properties listed for sale across the country. That sounds like a lot. It's actually up about 8% from the same week a year ago, but it's down about 50% from where we were prior to the pandemic. So we're looking at about a 3-month supply of homes available for sale across the country. In a normal, healthy market, we'd be looking at about a 6-month supply. So in some of the markets where you see more volume of activity, it's 2-month supply, 1.5-month supply. There's just not a lot of inventory, and where it's most severe, to one of Chris's points, is at the entry level. There's just about nothing available for sale at the entry level. It probably won't get a ton better on the existing home front this year because of something that the economists refer to as rate lock, which is where somebody simply can't afford to sell their house because they're sitting on a really inexpensive mortgage, and the cost penalty of selling that house and buying a new one would be just too severe. And just to give you a really simple example, let's say you sell a house and you have a 3% mortgage rate, and you buy a new house that costs exactly the same amount of money as the house you just sold. You've just doubled your monthly mortgage payments. And I know, Jeff, you gave Chris a 100% raise last year, but most CEOs haven't been quite that generous with their staffs. So people aren't being picky. It's not a psychological barrier. It's math. They simply can't afford to sell a house and get a mortgage rate that's twice as high as the one they currently have. The reason that's a problem is, according to Freddie Mac, over 2/3 of homeowners with a mortgage have a mortgage rate of 4% or lower, and 90% have a mortgage rate of 6% or lower. So until we see mortgage rates back down in the 5s, it just isn't likely that a lot of these people are going to even be able to list their property for sale. And so we see that listing inventory being very low. It's a little higher than it was a year ago, but it's a little bit of a head fake, because what we see is, once a property is listed, it takes a little longer to sell because of affordability issues. So it's not necessarily that a lot more properties are coming to market. It's just that the ones that are coming to market take a little bit longer to sell. So I don't see a big increase. Now, that said, we're still going to probably sell 4.3 million homes this year. So it's a lot of homes, but it tends to be people that need to sell. There's a marriage, there's a divorce, there's a job loss, there's a new job, there's a death, there's a birth. They're just life events that happen that cause people to sell. There are other people that perhaps are downsizing and they've amassed so much equity in their current home that they can afford to make that transition. So there will be properties listed, but it's going to be the people who would normally be thinking, hey, maybe now would be a nice time to move up, who just aren't going to be able to afford to do that, and that'll keep the existing home inventory low.
And maybe we should touch on equity as well. How much money has been kind of banked in all these? And it's not just single family owners, right? Investors that have been building generational wealth through these portfolios, they've done really well.
If you look at equity in single family homes, again, quoting Freddie Mac, current number is around $31 trillion of homeowner equity. And that covers all homeowners, whether they're individual owner occupants or investors who own these properties. So if you're just looking at the housing market, I keep in mind about that's for homeowners with mortgages. There's about a third of the housing stock out there that's owned free and clear. So lots and lots of equity. And this actually is keeping the inventory of distressed properties relatively low compared to other cycles, because depending on whose numbers you believe, and I've seen data from both Black Knight and Adam Data, somewhere between 65 and 80% of borrowers who are already in foreclosure have at least 20% equity in their homes. So you're not seeing those properties go to foreclosure sale or be repossessed by the lenders and brought back to the market as REO properties. These homeowners are protecting the equity they have by selling the homes before that foreclosure sale. And if the median price of a home is $400,000 and you have 20% equity, that's $80,000. And if you have to sell the property at a $10,000 discount, you're still walking away with 70, as opposed to losing all of that at the foreclosure sale. And so we're seeing an increasingly large number of distressed borrowers do just that. And again, that kind of keeps your foreclosure inventory, your distressed property inventory, lower than it might normally be.
So going back to our investor sentiment survey here, once again, the data is just amazing. Let's talk about some of the challenges that the investors talked about in the survey. Have they changed? What certain challenges are investors sort of keying in on that going into the spring market are really resonating with them?
Probably won't be a surprise to anybody who's heard the earlier parts of this conversation today, Jeff, but the two biggest obstacles that are routinely cited are the high cost of financing and the lack of inventory. About 74% of investors who took the survey cited high cost of financing as one of their top three challenges. 43% cited the lack of inventory. When they look out in the future, 6 months from now, we still saw about 67% believe that financing was going to be an issue. And about 46%, actually a slightly higher number, thought that inventory was going to be a problem. And those two have been pretty consistent through all the surveys we've done so far. The other big issue tends to be competition for that limited inventory. And about 35% view competition from institutional investors as a problem. About 26% view competition from consumer home buyers as an obstacle. The new one, we gave folks the choice of including insurance, the cost and availability of insurance, something we were talking about a little earlier. And about 19% cited it as a problem today and continued to believe it'll be a problem 6 months from now.
Interesting. Chris, certainly you're hearing this from all the account executives as to the challenges that the investors are experiencing.
Absolutely. And, Rick talked about it, right? These properties that don't make it to foreclosure now, you're not having all this inventory of REO properties. The challenge for the investor there is to adapt, right? How do I adapt? I swim upstream, right? I can't wait for a property to become an REO listing. I have to start finding, okay, who's a distressed borrower in this position already, and how do I go to that person to try to get them to sell me their house instead of, trying to just put it on the open market and seeing what's happening. So you really have to, as an investor, adapt to overcome the obstacle of inventory by getting to it before somebody else does, because that'll also help you with your competition problem there too, right? The rising rate environment really goes back to what we talked about before for the landlord investor, right? Making sure your numbers are going to pencil out ahead of time, right? Making sure you understand what the tax situation is going to be with that property, your expected insurance costs, and what you think you have an option to as far as raising rents within the units and trying to see if you have more opportunity there, right? So for investors, again, sharpen your pencils, get to work, and do the diligence ahead of time, because there's going to be challenges and you're not going to win those deals. I've done investing myself, right? And we used to say, well, you look at 20 properties for any one that you might buy. That number is going to increase, right? You might be looking at 40, 50 properties before you're actually able to buy the right property. So as an investor, you can't get discouraged because, hey, I've looked at a bunch of properties and this is the best one of the group that I've seen. You really got to make sure you're doing all your homework and finding as many properties as you can to find potential in, and trying to get them earlier in the process so that you have the opportunity with less competition.
Guys, one of the things that has shown up pretty consistently, and I don't think this percentage has varied very much. We have about a fifth of the respondents who talk about difficulty securing a loan. And Chris, I know this is where you live every day, and I would imagine that it's probably harder today for a new investor to get a loan. And I'd also imagine that maybe the criteria that lenders like RCN Capital look at before they issue a loan might have changed as financing costs went up and as the volume of home sales went down a little bit.
Yeah, you definitely see that in the marketplace, especially last year as we went through that rising rate environment. You didn't just get rate increases with that. You also got guideline changes to that, right? When the market looks a little bit like it might be heading in a negative direction, you're going to see a more conservative approach from lenders. So that's only natural to try to offset any of the future risks that might come with those loans that get made. But that said, for an investor, if you have challenges that are prohibiting you from getting to where you want to be, that's when we often talk to those investors about, well, who's on your team, right? Do you have other people on your team that can help supplement the things that you don't have, and suddenly that becomes a strength for your company, right? So some people are good at the finance side, some people are good at the contracting side, right? You might need to pair up with somebody else who can help fill the gaps for you, or maybe find a mentor who can help point you in the right direction. But one of the things that we're going to do here at RCN is make sure that, if you come to us and you have an investment strategy question like that, let's talk it out together. Let's understand what's possible for you, where your strengths and weaknesses lie, and then we can see what works best for you as an investor to find that property that's going to work for you, or find that strategy that's going to work for you, right? Not everybody is ready to be a hands-on landlord for a property that maybe requires a lot of high touch to it, right? That might be an overwhelming prospect for a first-time investor. But for those people who are looking to get into that market and to get an investment loan, you got to come with some, certainly qualified credentials that are going to make that process easy, right? How much cash do you have in the bank? How big is the project that you're taking on, right? For a first-time investor, I certainly don't want to see that they got a $500,000 rehab project going with a large addition and a bunch of permits they're going to need to pull. I'd like to see something a little bit more on the cosmetic side for that person, just to get their feet wet, make sure they're not getting in over their head and getting stuck with something they can't handle. Because one of the few things that you're going to see consistently from a first-time investor, whatever their timeline expectations are for completing that flip project, it's probably longer than they think. Whatever they think that it's going to cost, it's probably going to cost more than they think. Whatever they think the project was actually going to entail, there's probably going to be things that they didn't anticipate, right? You don't know. You start opening up walls and pulling things out. Next thing you know, you got knob and tube wiring you got to get replaced, or you got to upgrade a breaker, the furnace went, whatever it might be. Those surprises are going to happen. So as a first-time investor or a newer investor, you got to make sure you're well capitalized and that you can absorb some of those things that might happen along the way, because the unexpected is a natural part of this business. So the better you can do at planning for that stuff ahead of time and expecting, that you might actually have to come out of pocket for some of these add-on things, build a contingency in for yourself so you can afford to absorb those things and not get stuck with a project that's going to fail. Because our interest is in seeing that you're going to make all the way through that loan, be successful with it, and come back and do it again. We'd love to do it with you over and over again. But it's making sure you're going to be successful on that first one. So if you've got a lender who's telling you maybe there's a little proceed with caution here about that particular scenario that you submitted, I would heed that advice, right? Let's look at additional comps maybe and see if we can find something that supports our conclusions here, or maybe it's leading us to a different conclusion and we should maybe look at a different property to invest in.
Rick, there was some data in the sentiment survey regarding thoughts on fix and flip, which really in 2023 was on a downslide, right? Like we saw the folks continuing to really acquire rental properties at a pretty steady pace, but fix and flip has kind of been out of favor. What did some of the data show in the investor sentiment survey?
Well, this is the second time out of the 3 surveys that we fielded so far where the percentage of investors who were focusing on buying and holding properties for rental was significantly higher than the number of people who were fixing and flipping as their primary investment strategy. So it was about 46% of the survey respondents were buy and hold investors, and about 32% were fix and flip investors. Wholesaling was actually a pretty significant chunk. It was about 22% of the people that responded were wholesaling, and they're typically selling the properties they find to the fix and flip investors or the buy and hold investors. This tracks what we're seeing elsewhere in terms of industry data, Jeff. In Adam Data's third quarter report on the fix and flip market, there were about 70,000 properties that were flipped in the quarter. That's the lowest number we've seen in several years, and was, I believe, the third consecutive quarter where there were fewer properties flipped than the quarter before. And Chris was talking about this a little bit earlier. You're in a rising rate environment where home prices have been kind of sluggish. And a lot of prospective buyers have been priced out of the market because of the combination of high prices and high financing. And that really made life a little rough for flippers. We haven't talked about this, but another survey or another report I've been working on shows that the cost of repairs has gone up about 5% annually. And that also adds a burden to your fix and flip investor to try and make the numbers pencil out. So the good news for flippers is we've seen gross margins start to improve. So the price the property was purchased for versus the price the property was sold for, that gross margin has improved for a couple of quarters in a row. We are in an environment now where we're seeing mortgage rates, financing rates come down a little bit, and we're seeing home prices start to recover in just about every market in the country. So it's a better environment for flippers, and it could be that if not the third quarter of last year, then probably at least the fourth quarter is where the market bottoms out, and we could start to see more flipping activity come back this year. Interestingly, though, both flippers and rental property owners believe they're going to buy about the same number of properties they did a year ago. So it's not a significant statistical difference between how many properties the flippers bought last year versus what they're planning, or rental property owners bought versus what they're planning to buy.
Yeah, the data really tells the story, without a doubt. The data tells the story on what investors are thinking, and it kind of just goes to Chris, what we're seeing at RCN, which is continued aggregation of single-family homes for rent. The deals continue to pencil out, even with some of the challenges that we've been talking about here today, but the beat goes on.
Yeah, investors still have opportunity to make good investments, find real properties that are going to cash flow for them or flip well for them. The deals are still out there. You just have to work harder to find them. But one of the other strategies we've seen investors shift to is, hey, if you can't find the inventory, go build your own. And we've seen a significant uptick in our ground-up construction product over the last year, where people are starting to take that on and seeing all these opportunities in established markets where there's an open lot, they can buy the land for cheap, they can build their own thing, and boy, the margin on that starts to look a little bit better. And with a new home coming to market, you also have a better likelihood that your sale is going to be quick and efficient and at the right price point too.
Rick, thoughts about ground up and how it's changed the marketplace across the U.S.?
You know, it's funny Chris mentioned that because we're seeing the same thing on the institutional investment side. There's a movement toward diverting funds that were used to go out and compete with other buyers to buy existing properties, now going to work directly with builders and building entire communities of single-family homes to rent out. So I think it's a strategy that's being deployed from small individual investors who are building one house from the ground up to your biggest of the big institutions who are going out and building entire investment or rental property communities. And it's probably just a reflection on how extremely difficult it is to find any existing inventory to buy in today's market, where we still have people not listing their properties, and we have a lot of people coming to market looking to buy.
Yeah, and I'll tell you, the nice thing about that is the most really beneficial thing for the United States as a whole is that starts to solve the housing shortage. As great as it is to rehab existing houses, they're existing houses, and it's great to bring them up to speed. But when we start talking about building ground up, that solves the problem, Rick.
Yeah, and the investor community very often gets blamed for, the housing shortage, which is a specious argument. It's ridiculous. The reason we have a housing shortage is because builders haven't kept pace with population. It's pretty simple and pretty straightforward. Building these properties from the ground up, perhaps as rental properties, takes investors out of that spotlight. Takes them out of you're gobbling up existing inventory that my poor, son and daughter can't buy as a property because you're a greedy investor. And that's never been the case, but it kind of removes that argument entirely. It's like, no, I'm adding to the inventory now. And I can't be blamed for Junior or Missy not being able to buy that first house.
Well, I'll tell you what, we're coming up to the top of the hour here. It's been a great conversation. As I said, the data in this investor sentiment survey really speaks volumes about what's happening in the marketplace. And I urge everyone to download it from the QR code that'll be available on the end of this presentation. Just amazing stuff. Rick, thank you for your partnership. Look forward to doing this again next month.
Absolutely. Thanks for a great conversation, guys.
And how about the new guy?
He done good.
Fantastic. We'll see you again soon.
Thanks, Rick.